The ideal portfolio with just 2 to 3 ETFs or mutual funds. What is it? And what can you expect to get out of this video? When you're done watching this video, you'll be able to explain why each investment is in your portfolio and its role. Anyone worth their salt as a money manager should be able to tell you this as well. In this video, I'm going to cover how to create a portfolio using just 2 to 3 ETFs or mutual funds. You don't need more than that to have a diversified portfolio if you know which 2 ETF classes to use, and I'll show you that. If you would like to learn how to create this portfolio using individual stocks, then watch my video titled The Ideal Portfolio Using Individual Stocks. Link in the pinned comments below. The ideal portfolio will be influenced by the risk tolerance and investment goals of you, the investor. But as a money manager for many clients, I will tell you what works well for all my clients is to balance their desire for return, and boy, they have that, versus their ability to tolerate losses. Look, as anyone knows who has lived through the dot-com bubble in 2000, the financial crisis in 2008, the pandemic in 2020, and the more recent unbelievable interest rate increases by our Fed in 2022, losses are going to inevitably happen. But before we get into the details of portfolio design, the most important piece of advice I'm going to give you in this video, or any of my videos for that matter, is this. To succeed as an investor, you must take the long view and hold on to your allocations no matter what the market conditions, and dollar cost average into your investment accounts over time during both good and bad markets. If you think you can save yourself by selling your holdings when your portfolio is at a loss and then be genius enough to get back in before the market is recovered, you're sorely mistaken. The biggest mistake you can make as an investor is to sell your risk holdings when your portfolio is down a significant amount. To be a real investor, you'll be investing for the long term, meaning a period of at least 10 years. You're not investing in the current market PE ratio or the current market conditions. There's a big difference between being a trader and being an investor. If you have any doubts about this advice, I'll put a link in the comments below to a YouTube short video titled The Biggest Investment Mistake You're Tempted to Make Right Now. And I'll also link a blog article I wrote that discusses the damage caused by investors when they become afraid and sell their losses at or near the market bottom, also linked in the comments below. But let's get back to portfolio design. I like to use the design of a pyramid for the design of a portfolio. The details and the proportions of the pyramid segments will depend on your desire for growth versus your tolerance for losses and risk. There are 3 sections of the portfolio. First of all, a base of safe haven assets utilizing U.S. government treasuries and cash. You can see that here. Then we add a middle section of what I call stable growth stocks. These are usually stocks in the consumer staples sector. And then finally, right at the top, the smallest section consisting of high growth stocks or ETFs, typically in technology, but who knows if this will hold going forward. And you can see the range of the amounts that you might invest in each one of these sections. Most people, whether they realize it or not, want a strong base that is safe and can support the rest of the portfolio structure during bad times. And this is something that's really important. Return is not your main objective in this safety portion of your portfolio. Safety is your main objective. It's a huge mistake to reach for a return in the safety portion of your portfolio because reaching for a return means taking more risk. This safe haven portion of your portfolio should be invested in U.S. government treasuries, and that's going to become really obvious later when I show the nonlinear effect they have on your portfolio returns and maximum losses. And look, if you're a super aggressive investor with a high tolerance for volatility and losses, I caution you not to leave the stable base off and shoot for the moon. You won't be protected in the case where there's a catastrophic loss due to an unforeseen event. You could lose most of your portfolio very quickly in a situation like that. And look, while we haven't seen a situation like that yet, it could, and most likely will happen at some point in the future. And you don't want to be that guy standing there saying, oh my God, I lost 80, 90, 95% of my portfolio. What do I do now? Don't be that person. The reason I'm telling you all this is because many investors become extremely afraid when facing these kinds of severe losses, and they sell their holdings at or near the bottom. Selling holdings at or near the bottom locks in your losses. Why? Because it puts them in cash with no potential upside. And then, of course, as the markets recover, as they always do, you get left behind. Think about it. Then, to make matters worse, the assets don't get reinvested until well past the bottom, and this causes the portfolio to take many years, if not a decade or more, just to recover to its previous high watermark. Now that we've discussed how important that base of safety is in the portfolio construction, let's talk about how to optimize the risk asset or equity side of your portfolio. As I said earlier, the middle section here should be somewhat stable but with good growth prospects. And this top section, where you're going to put the high growth equities, should be exposed to high growth companies with high return prospects. The reason this structure works for most investors is because it provides unlimited upside via the risk portion with limited downside via the safety portion, or as Nassim Nicholas Taleb describes it, Antifragile, in his book titled Antifragile: Things That Gain from Disorder. You can create this type of portfolio with mutual funds, ETFs, individual stocks, or with a combination of all of them. And contrary to popular belief, it's not difficult to do, and it's definitely not rocket science.
Truth about the one I love.
So how many ETFs do you need? Well, the short answer is surprisingly few. 2 to 3 ETFs or mutual funds is more than enough to implement a successful portfolio if you know what you're doing. And by the end of this video, you'll understand why you're selecting each ETF or mutual fund in your portfolio. In fact, trust me, if you pick more than 2 or 3 ETFs, you'll end up stifling your returns while not getting any additional protection from losses. That doesn't sound very good, does it? Let's take a look at a portfolio using just 2 ETFs that you might want to consider. It's very easy. It's a set it and forget it portfolio. Let's take a look. So if you've seen some of my previous videos, you're very familiar with this graph. But if you haven't seen these videos, what you're looking at here is return on the vertical axis and maximum loss on the horizontal axis. So basically anything up here, up and to the left, is good, and anything down and to the right is bad. Very simple. And right now, all of the portfolio, 100% of it, is in the Treasury ETF called IEF. These are 7 to 10 year treasuries. I call them kind of intermediate to long treasuries. So let's take a look at a 2 ETF portfolio and see how it might perform. So in this first portfolio, I'm just going to take 60% S&P 500 and combine it with 40% long bond treasuries, TLT, and you'll see that here. And first of all, you'll notice something kind of strange about this portfolio. Now, normally if you take 2 investments, so here's the S&P 500, which I don't recommend you use, but we'll talk about that later. Actually, I talk about that in an entire video called Why You Should Stop Investing in the S&P 500 Now. I'll link that in the pinned comments below as well. But what you would normally expect to see here is you have these 2 investments. You got 60% in the S&P 500 and 40% in TLT. You would expect the portfolio, this big white ball, to fall right in between them, right? Well, this is why we use government treasuries, because they act in a non-linear way with equities most of the time. Not all of the time, certainly not in 2022 when the Fed was cranking up rates like a maniac. But you can see here, even including that period of time, with a 20-year period looking back, that adding these 2 things together, this portfolio has better loss characteristics than either one of these. So it has a 29% loss, where this one had a 55% loss. And the return is pretty good. It had a 11.5% return, where the S&P had basically about a 13% return. So this is a really good trade-off, and you're just using 2 ETFs. Now, I'm not a fan of the S&P 500, but what happens here if instead of the S&P 500, we use the NASDAQ 100? And you see that the return goes way up. It's quite a bit higher here. In fact, we're beating the S&P 500, and the loss is still better than either one of these. So this is a really good alternative. Simple portfolio. You can do it with 2 ETFs or 2 mutual funds. Set it and forget it, and you'll be very happy over the long term, as long as we don't have any major catastrophes that blow away your portfolio. But again, you've got a fairly healthy chunk of safety here. So if something really bad happens, this may shrink to 0, or it might go down by 90 or 95%, but this is going to blow up. So that will help save you in a really, really bad event. But you're saying, but Calvin, what happened to that pyramid you told us about with the safety and the consumer staple stocks and the high growth stocks? We can do that with ETFs as well. So let's switch this up a little bit. Let's use the NASDAQ 100 as our risk assets, and let's use an ETF called XLP. It's a consumer staples sector ETF, and we'll make that sort of the middle part of our pyramid, and we'll make the NASDAQ 100 the peak of the pyramid. Now you can see what happens is my return dropped a little bit here, went from 14+% down to about 12.3, 12.4. So not terrible. It's still getting good returns here, but you'll see that the loss went from minus 33% down to minus roughly 25%. So this is a really good trade-off. Now, if you don't have access to XLP, you should. If you're in most brokerage accounts, you can also use the Dow Jones Industrial Average. It's not quite as good as a consumer staples ETF, but you kind of end up with a similar result here, as you can see. So very simple portfolio, very easy to implement. And by the way, let's go back to XLP because I think that's the better choice here. We'll put XLP back in. If I now, instead of having 60% exposed to equity risk, let's make it only 40%. So let's make the portfolio a little more moderate. And you can see now we've reduced our equity exposure here. So it's now only 40%, and 60% is in the ETF IEF, which is 7 to 10 year treasuries. And you can see that the return dropped a bit, but also the maximum loss is much lower here. And by the way, if you look at the return and loss of AGG, which is the aggregate bond index, supposedly very safe, so this little blood red dot here, you can see that you got a 4.16% return, which is pretty anemic, but your loss is 18.43%. That's worse. That's worse than this portfolio with a lot less return. So why wouldn't you do this? This is a really, really good portfolio for most people. Now, if you're really conservative and you don't want to lose any money or very little money, there are things you can do here. And if you want even less loss in your portfolio, you want to be super conservative, you can shrink your risk exposure to, let's say, 20%. But that's not going to improve your risk exposure here. It actually made your maximum loss a little worse. So what you have to do is then take a fairly good chunk of your IEF component, and maybe instead of 80% in IEF, we only put 20% there, and then put the rest in treasuries and T-bills, which are very, very safe. So now you can see we've got a very good return, 5%, much better than AGG, who had 4%. But look at our loss characteristics, minus 7%. That's really not bad at all. And if you want a little more return than that with a little more loss, then bump IEF up to 30%. So now you've got a chunk down here in treasuries, and we've got a pretty good chunk in IEF. So a little more return, a little more loss. You can play with that if you want to have a very conservative portfolio. So do you see how easy this is? Like I said earlier, it's not rocket science. Do yourself a favor and don't listen to the common wisdom when it comes to investments. And we've all heard them, things like rebalance often and no one ever got hurt by taking profits. And diversify, diversify, diversify. These great wisdoms are thrown around to make you think the people saying them actually understand what they mean and how they'll affect your portfolio performance. But I've got news for you, they don't. If you need proof, just watch my video titled, Why Most Money Managers and Retail Investors Will Never Beat the S&P 500, or my other video, Stop Investing in the S&P 500 Now. Links in the pinned comments below. As I said earlier, creating portfolios that perform well isn't difficult, and you can do it yourself with just 2 or 3 ETFs or mutual funds. And remember to be a long-term investor and measure your progress in decades, not in the most recent one-year performance. Until next time, I'm Calvin Rose, and thank you for watching Invest Smarter. That's all for now.
It's just not everything you promised. Running around, trying out. What did you say? What did you say when I told you? Maybe this wrist wasn't gold proof. Packing my bags like it's all true. Hard to make friends when I'm focused on all these bars that I'm holding. I like the cold, but it's lonely, yeah. This life feels like the sunny water.